Welcome back to Investing Talk Podcast.
Today we're looking at AMD. And honestly, it's not just another semiconductor deep dive. We are talking about what I would call a tectonic shift in the entire AI hierarchy. We're going to get into why they aren't just playing catch-up to NVIDIA anymore, but how they're basically changing the shape of the battlefield.
As usual, before we start, subscribe, like, and comment to this video to support the show. It really helps us get this research out to more learners like you.
So why does this matter right now? Well, it's Thursday, February 26th, 2026, and the landscape of compute power just got a massive jolt. We are looking at a structural shift involving a brand new partnership with Meta that is, frankly, it's staggering in scale.
Okay, I want to pause you right there on the word staggering. Because, usually when I hear that word in tech, it's marketing fluff. And then I look at the actual charts, which we will get to in a bit, and I see a stock that looks like a crime scene. It's been a really rough month for them. So if this news is so staggering, why is the stock down?
Yeah, it has been painful. I mean, I won't sugarcoat the volatility for you. If you're holding the stock right now, it hurts. But that volatility is masking a massive movement under the surface. We're talking about a partnership covering up to 6 gigawatts of compute.
6 gigawatts.
Yeah.
I see that number in our notes, but I think for most people listening, gigawatt is just a made-up word from Back to the Future. Can we contextualize that? What does 6 gigawatts actually mean in the real world of data centers?
It's monumental. So to put that in perspective for you, a standard massive enterprise data center might run somewhere around 100 megawatts, so 6 gigawatts. That is roughly the power consumption of a small country.
Wow.
Yeah, we are talking about infrastructure on a literal nation-state scale. This isn't just Meta buying a few chips for a server rack. This is building an entirely new power grid for AI. And despite the stock being down 18% in the last month, the thesis here is that AMD has finally built a moat that even the giant in the room, NVIDIA, might really struggle to cross.
That is a bold claim. Because right now, NVIDIA is basically the god of this industry. But before we get carried away with the shiny new Meta deal, I want to look at the engine room. Let's look at the fundamentals. Because if the base isn't solid, a partnership is just a press release. What are the core numbers actually telling us?
The numbers are telling a story of extreme resilience and very specific targeted growth. First off, their annual revenue has surpassed $25 billion. And $25 billion puts you in the absolute big leagues of tech.
Sure, $25 billion is a lot, but is that stagnant? Are they just treading water? Because in the tech space, if you aren't growing, you're essentially dying.
Oh, they are definitely not dying. This isn't some one-off spike from a good quarter. They've shown consistent double-digit annual revenue increases for the last 5 years straight. They are compounding that growth. But the real story, the metric you absolutely need to circle in red, is the data center segment.
Right, because that's where the high margins are. That's the whole AI gold rush.
Exactly. Management is currently targeting 60% growth in the data center segment alone.
Whoa, hold on. 60%? In a hardware market, that sounds incredibly aggressive. Almost suspiciously aggressive, if I'm being honest. How exactly do they plan to hit that?
It is super aggressive. But it's entirely driven by their MI300 accelerators. The demand is already there. They aren't building these chips to sit in a warehouse. They are selling every single one they can manufacture. The limiting factor right now isn't finding buyers. It's literally just how fast they can get them out of the fabrication plants.
Okay, so demand is high. But I have to play the skeptic here for a second. I'm looking at the Q2 fiscal 2025 results. And yes, they beat revenue estimates. Good job, high fives all around. But they missed on earnings per share. Adjusted EPS was a slight miss. And in this market environment, if you miss earnings, you get punished. That usually signals that spending is running too hot and eating into profits.
It is running high, you're completely right. But you have to look at why it's high. You can spend money on fancy corporate lunches, or you can spend money on building the future. That EPS miss wasn't because they lost operational efficiency or because inflation drove up costs. It was specifically due to aggressive R&D spending and ramping up their manufacturing capacity.
So they're spending to capture the market share.
Exactly. They are aggressively spending to capture share in that high-margin AI accelerator market. It's an investment, not a leak in the boat. Think of it as buying brand new drilling rigs because you just found a massive oil field. You don't complain about the upfront cost of the rigs if you know the oil is right there.
Fair enough. If the oil's there, you buy the drills. Let's talk about their bank account then. Because if you're going to spend money to fight a giant like NVIDIA, you need a serious war chest. I'm analyzing the balance sheet here, and I have to admit, it looks like a fortress.
It absolutely is. This is arguably one of the cleanest balance sheets in the entire semiconductor sector.
We're looking at $10.6 billion in cash against roughly $3.85 billion in debt. That's a net cash position of about $6.75 billion. That is a massive amount of dry powder.
It is. And that liquidity gives them so many options. In a high-rate environment, cash is oxygen. It allows for these strategic partnerships like the Meta one we're going to break down, and it funds that massive R&D budget without them needing to go to the bank and take on bad debt. And speaking of R&D, they are currently spending about $5 billion annually.
Now, to play devil's advocate again, $5 billion sounds like a lot of money to you and me. But NVIDIA is spending upwards of $8 billion on R&D. So AMD is being outspent nearly 2 to 1. Does that worry you? I mean, can you win a tech war when the other guy has double the ammo?
On the surface, maybe it looks worrying. If it were just a pure spending contest, NVIDIA wins every time. But this is where it gets really interesting for you as an investor. You have to look at capital efficiency. AMD is achieving comparable GPU performance at significantly lower price points. Their productivity per dollar spent in R&D is arguably much, much higher.
So they do more with less.
Exactly. They've always been the scrappy underdog. They've been battling Intel for decades. And that culture of lean efficiency is deeply baked into their engineering teams. They know how to stretch a dollar better than anyone.
So they are the scrappy underdog that's actually efficient. But efficiency doesn't always equal a structural moat. NVIDIA has a moat the size of the Pacific Ocean. How does AMD actually compete structurally? Because just trying harder isn't a business strategy.
No, trying hard is not a strategy. But they have 3 interlocking advantages that create their own unique moat. First is integration. This is the secret sauce that NVIDIA literally cannot copy right now. AMD dominates the CPU space with their EPYC server processors.
Right, the CPUs are the actual brains of the servers that run the cloud. NVIDIA is mostly just the muscle with the GPU.
Precisely. NVIDIA is the muscle, AMD is the brain and the muscle. So AMD can bundle the CPU and the GPU together for these massive data centers. They offer a holistic solution. NVIDIA is entirely GPU-centric. AMD comes in and says, we can run the whole rack for you. That reduces switching costs for customers, and it increases AMD's share of the wallet. It drastically simplifies the supply chain for a data center builder because you have one throat to choke if something goes wrong.
Okay, so advantage 1 is owning the whole board, both CPU and GPU. What's number 2?
Price to performance. And we have to get really specific here. Look at the new RDNA 4 architecture. We have seen the specs on the RX 9070 XT.
And that's the new consumer card, right?
It is, but remember, consumer tech often previews the enterprise capability. The RX 9070 XT perfectly matches NVIDIA's 5070 Ti in sheer performance. And crucially, that includes ray tracing.
Which historically was AMD's Achilles heel. Their lighting effects always lagged way behind NVIDIA.
Right, but they have completely closed that gap now. And here's the kicker for the consumer. It is $200 cheaper.
$200 is not insignificant. I mean, in the consumer world, that's a massive difference. That's the difference between just buying the graphics card or buying the card and a brand new high-end monitor.
Exactly. And that value proposition completely erodes NVIDIA's pricing power. If you can get the exact same performance for significantly less capital expenditure, the CFOs at these big data centers start paying close attention. When you're buying 10,000 chips, a lower price point saves you millions of dollars.
Yeah.
It forces NVIDIA to compete on price, which is something they absolutely hate doing.
Which brings us to the third point, and probably the biggest news of the day, the Meta partnership. You tease this at the top with that 6 gigawatts number, but let's really drill down. What exactly did they announce today, February 26th?
This is the massive catalyst. It's a multi-year, multi-billion-dollar deal. Meta is officially committing to using AMD for up to 6 gigawatts of customized AI compute.
We established that as a massive amount of power. But there was a specific detail in the contract that caught my eye. It wasn't just a standard purchase order. It wasn't just Meta saying, we will buy your chips.
You saw it. Yes, here is the detail that really signals how serious this is. Meta may acquire up to a 10% equity stake in AMD through performance-based warrants.
Whoa. Let's make sure everyone listening understands what that means. A warrant is basically an option to buy stock at a set price. So Meta isn't just a customer here. They are potentially becoming an owner.
Exactly. That aligns their incentives perfectly. Meta actively wants AMD to win. If AMD stock goes up, Meta makes billions. They are co-developing the silicon together. This validates AMD's technology roadmap in a way that literally nothing else could.
Yeah.
It locks in long-term revenue visibility. It basically says, we are in this boat together for the long haul. It's a marriage contract, not just a casual date.
And it probably makes NVIDIA sweat a little bit, because Meta is historically one of NVIDIA's absolute biggest customers.
More than a little bit. Look, NVIDIA has 92% of the discrete GPU market share. That is a pure monopoly. But AMD is now up to 7%, and they gained 0.8% just in Q3 of 2025. Intel is finally on the board with 1%. But this deal with Meta, it heavily signals that the hyperscalers, the Googles, the Metas, the Amazons, they're willing to co-develop custom silicon specifically to break NVIDIA's leverage. They don't want a monopoly supplier any more than you or I do. They are actively funding the competition to force a balanced market.
So the moat is actually eroding, even if it's just by a few percentage points right now. The customers are actively funding the rebellion.
The cracks are absolutely forming in the dam.
All right, so fundamentally, the house is made of brick. The company is healthy, the tech is highly competitive, and they just landed a whale of a partner. But let's actually transition over to the technicals and the price action, because the chart tells a very different story. We need to bridge the gap between this rosy fundamental picture and the ugly reality of the stock price. If you bought this stock a month ago, you aren't feeling very fortress-like. You're feeling a lot of pain.
You certainly are.
The stock is in a severe drawdown. It has declined approximately 18% in the past month alone, largely following that Q4 earnings report. For the technical trader looking at this, it looks ugly. It looks like catching a falling knife. Or does it?
Well, it really depends on your time frame. To me, and especially looking at the institutional flows, this looks like a classic valuation reset. The market simply got way ahead of itself, the earnings weren't absolutely flawless, and the price corrected hard. But that correction creates a prime setup for mean reversion.
Mean reversion essentially meaning the stock is stretched too far down like a rubber band and needs to snap back up to its historical average.
Exactly. Nothing falls in a straight line forever, just like nothing goes up forever. And we aren't the only ones thinking that today. We have to talk about the institutional flows we literally just saw hit the tape.
You're talking about the ARK effect.
The ARK buy, yes. On this very day, February 26th, 2026, Cathie Wood's ARK Invest executed significant, massive purchases of AMD.
Now, Cathie Wood is a very polarizing figure in finance. Some people love her, some people hate her, but she is undeniably a high-conviction growth investor. When she buys for a specific researched reason.
And she buys in clusters. This wasn't just a tiny nibble to test the waters. It was a significant position increase during a major dip. That signals massive institutional confidence in the long-term AI narrative here. She is completely looking past the 18% drop and focusing directly on the 6 gigawatts of compute. She clearly sees the Meta deal as the ultimate validation of her thesis.
So you basically have the smart money, or at least the aggressive growth money, stepping in right when retail investors might be panicking and selling. That is usually a classic bullish divergence.
It is. It's a very strong signal that the bottom might actually be in. Institutional investors don't try to catch falling knives unless they know exactly where the floor is.
Which is a perfect bridge to market perception. Let's transition over to sentiment. How is the broader market actually feeling about this? Because sometimes the general vibes drive the price action a lot more than the PE ratio does.
Quantitatively speaking, the overall sentiment is actually bullish. And that might surprise you given the nasty price action recently. But the algorithms and the smart analysts are looking at the news flow, and the weight of the Meta partnership is vastly outweighing the negative price drop.
What are the analysts actually doing, though? Are they cutting their price targets? Usually when a stock drops 20%, the analysts downgrade it just to save face. They chase the price down.
Actually, it's quite the opposite here. Bank of America has completely reset their price target following the Meta deal announcement today. The language in their note heavily implies an upside revision is coming. They see this deal as a material change in the company's future cash flows. They aren't scared of the dip at all. They see the fundamental value of the business increasing.
And what about the competition? Usually you can tell how well a company is doing by how annoyed their main competitors are. What is NVIDIA actually saying about all this?
This is where it gets absolutely fascinating. NVIDIA CEO Jensen Huang recently made some very pointed comments about computing ratios flipping. He said, "We are rapidly moving from a world of 90% CPU and 10% GPU to the exact inverse."
Meaning the GPU becomes the absolute center of the universe.
Yeah.
Which makes perfect sense for him to say since he sells GPUs.
Right, of course. But if you read between the lines, why is he emphasizing that specific ratio so heavily right now? It strongly suggests he is worried about AMD's dominance in the CPU space, that integration advantage we talked about earlier. It suggests NVIDIA might actually try to pivot and build their own CPUs to compete with AMD's EPYC franchise.
So NVIDIA is trying to figure out how to build a CPU to stop AMD, while AMD is aggressively building GPUs to stop NVIDIA. They are literally invading each other's territory.
Precisely. And the mere fact that Jensen is talking about it validates AMD's threat level. You do not talk about competitors that don't matter to your bottom line. If AMD was irrelevant, he wouldn't mention CPU ratios at all. He's actively playing defense.
What about on the retail side? The gamers, the people who actually buy these physical cards for their home PCs, because sometimes consumer trends are the best leading indicator of enterprise shifts.
The retail view is definitely warming up. The RX 9000 series is gaining serious traction. And why? Because a $200 savings genuinely matters to a normal consumer.
Yeah.
If you can get top-tier ray tracing and high frame rates and keep $200 in your pocket, that long-standing loyalty to the green team to NVIDIA, it really starts to fade. Inflation is real. People always vote with their wallets eventually.
Money talks. Okay, so we've been pretty positive so far in this deep dive. We've praised the balance sheet, the massive Meta deal, the savvy ARK buying. But I am a skeptic here. It is my job to ruin the party. We need to pivot to the bear case and look at the actual risks here. Where are the hidden landmines?
The biggest landmine, and it's one we discuss fairly often in this sector, is the ecosystem moat.
You're talking about CDA.
CD, yes. NVIDIA's proprietary software stack. It includes CD, CUDA, TensorArt. This creates absolutely massive switching costs for any business. Enterprises have spent 10 years optimizing their code specifically for CUDA. It's like a language. If all your developers speak English fluently and you try to introduce a brand new system that only runs on French, you have a massive problem. You can't just swap out a physical chip. You have to literally rewrite your entire code base. It is incredibly sticky.
And AMD's open source alternative, ROCm, has a reputation in the industry for being, let's say, fussy.
It's definitely improving, but it is not nearly as mature. It's like learning a new programming language that is still actively being written. It works, but it has bugs and lacks documentation. However, and this is the crucial counterpoint, the Meta partnership mitigates this specific risk significantly.
How so? How does Meta buying a ton of hardware fix AMD's software problem?
Because Meta isn't just buying off-the-shelf chips and trying to clumsily run old code on them. They are co-developing the silicon and the software stack directly with AMD. They are entirely bypassing the need for generic CUDA support because they are building a highly custom solution from the ground up. If you are big enough, you don't need CUDA. You just build your own road.
That makes perfect sense for a giant like Meta. But for the smaller enterprise, the generic Fortune 500 company trying to train a model, CUDA is still a massive hurdle. They can't afford to build their own custom road.
That's entirely true. That is the lingering risk here. AMD will win the tech giants first because the giants have the deep engineering resources to actually make the switch. Winning the broader mass market is much harder, and it will take a lot longer.
What about the stock itself? We mentioned the 18% drop. Is there a realistic risk it just keeps dropping?
Absolutely there is. That is risk number 2. Valuation compression. The market is completely unforgiving right now regarding AI names. This is strictly a show-me story now.
Flawless execution is required.
Yes. If Q4 earnings, which are coming up fast in late March 2026, if they disappoint in any way, or if that Meta deal doesn't show immediate, tangible revenue recognition, the stock could easily fall further. The market has priced in a whole lot of hope in future growth. If the reality lags the hope even slightly, the price will correct again.
So we were basically walking a tightrope. The potential upside is massive, but the execution has to be completely flawless. One tiny slip up on the supply chain side or one delay in the Meta rollout, and that hard-fought 7% market share gain could just stall out completely.
Exactly. It's a very high-stakes game. As an investor, you are betting on them executing a perfect maneuver against an incredibly dominant, well-funded monopoly.
All right, we've covered a lot of ground today. We've looked at the Fortress balance sheet, the massive Meta deal, the technical drawdown, and the very real risks of the CDA moat. It's time for the final verdict. I want a hard number. Based on all our research, what is the score?
Taking absolutely everything into account, the structural shift in the industry, the strong financials, and the execution risks, I am giving this a bullish score of 7.5 out of 10.
7.5. That is a really solid confidence interval. Not a perfect 10, but undeniably high. Summarize the core thesis for us. Why exactly 7.5?
It ultimately comes down to this. AMD is the only credible alternative to NVIDIA on the planet right now, and the broader market desperately needs an alternative. The Meta partnership provides multi-year revenue visibility that we simply didn't have before today, and the potential 10% equity stake aligns their incentives in a way that truly safeguards the deal. The 60% data center growth target is aggressive, yes, but with the MI300 chips and this new mega partnership, it is mathematically achievable. We are essentially betting on the market needing a second major player, and AMD is the only company fit to wear the jersey.
And for the listener trying to figure out how to actually play this in their portfolio, what is the right time horizon? Are we buying this for a quick pop tomorrow or for next year?
If you are an active trader, there is a clear swing trade opportunity here heading into the Q4 earnings in late March 2026. You are specifically looking for a potential guidance surprise or a classic sell the rumor, buy the news event on the actual earnings print. The technical chart strongly suggests a bounce is due because the rubber band is stretched way too far to the downside.
And for the longer-term investor, the person looking to put this in their retirement account and forget about it.
For the long term, this is a 12 to 36-month hold. You are patiently waiting for the RDNA4 architecture to fully saturate the consumer market and for the massive meta deal to actually mature and show up on the balance sheet. You are buying the structural shift in AI, not the quarterly noise, but you absolutely have to be willing to stomach the kind of wild volatility we've seen this past month.
Before we wrap, it leaves you wondering if Meta's doing this today, how long until Apple or Google announce a similar custom silicon partnership? It could completely reshape the industry. That's the thesis. If you found value, hit subscribe, like the video, and leave a comment. Tell us if you think AMD can actually dethrone NVIDIA or if they are permanently destined for second place.
We'll see you in the next deep dive.
Thanks for listening.